Think of the ultimate financial dream, sitting back and watching cash roll into your account without lifting a finger. Building a reliable stream of passive income is why most of us look to the stock market in the first place. In the Indian market, retail investors consistently turn to one specific massive player to make that dream happen: Vedanta. It has built a massive following, largely because of its highly attractive, regular, and historic dividend payouts. Warning tone, but there is a well-known trap here called dividend chasing. People see the massive yield percentage next to the ticker symbol and buy in, caring only about the next payout. Buying a stock strictly for the yield creates a blind spot. Without understanding the industrial engine behind the dividend, investors cannot see the factors that might suddenly interrupt the flow of cash. Assessing the safety of these payments requires an evaluation of Vedanta's physical footprint and the specific markets it serves. Because ultimately, a stock's dividend is only as reliable as the physical, earth-moving machine generating the cash in the real world. We are looking at an operation built on heavy reality. Vedanta doesn't sell digital software or cloud storage. They operate at a sheer physical scale that carves into the earth itself. Their core operations begin deep within massive terrestrial sites, extracting essential raw materials like iron ores straight from the ground. The dirt and ore are then subjected to intense industrial smelting and processing, transforming base metals like copper and zinc into usable forms. The end result of this massive logistical chain is staggering volumes of pure, saleable materials, stacked and ready to feed the global trade network. But their footprint extends past metals into an entirely separate energy pillar. They hold a significant extraction presence in the oil and gas sector out in the open ocean. Extracting that secondary energy resource requires vast infrastructure to store, manage, and ultimately distribute millions of barrels. Long-term investors look at this massive structural diversity and see security. If the zinc market slows down, oil or iron ore can carry the weight, preventing the company from collapsing if a single product line fails. But there is a massive catch to owning all these raw materials. Vedanta does not get to dictate the price of the products they sell. This is the reality of commodity dependency. Apple can set the price of an iPhone, but a ton of zinc or a barrel of oil is strictly priced by the rapidly fluctuating global market. When global demand surges, prices skyrocket. During these boom cycles, Vedanta prints money, and that excess cash aggressively flows straight out to investors. But the cycle always swings back. If global manufacturing slows down, the market prices for those metals and oil drop, and the company's profit margins shrink instantly. When the global commodity price plunges, it triggers a synchronized collapse of the profit margin directly beneath it. Hitting a negative threshold completely severs the cash available for that famous investor payout. The money simply isn't there. This quarterly payout fluctuates alongside the volatile global commodity cycle, rising and falling with the market price of the raw materials Vedanta sells. Understanding Vedanta requires viewing it as a heavy industry cyclical producer, subject to the same pressures as any major mining or energy conglomerate. Its sheer diversity protects it from isolated shocks, but its overall success remains permanently tethered to unpredictable global markets. So, to evaluate this stock's future, you cannot just look at the current share price or the historic yield. You must evaluate where the global demand for oil, aluminum, and iron is heading. Never commit your capital based on a surface-level number. Always conduct your own deep research into the underlying business and the macro trends driving it. True market success comes from looking past the surface appeal of a high yield. If you want to master how these businesses actually function, make sure to follow the channel.